Welcome to Trade the Trend, a weekly video about where the stock market is going. This video is going to focus on the S&P 500. I'm going to cover the ASX 200 as well as gold and uranium in a separate video. I'll leave a link for that in the description section below. I'm also going to show you a market that's breaking down, and it's breaking down in a bad way, so make sure you stick around for that. As always, this is general commentary. It doesn't take your personal situation into account. With all of that said, let's get into our first chart. So let's start off with the S&P 500, and this remains a story of consolidation. The consolidation that was spoken about over the last couple of weeks has continued to unfold. And when you look at this chart, the dominant feature remains this big trading range that the market broke out from in May. That remains the key feature on the chart. And the thing with the trading range is that you can project targets, potential targets, after a breakout. So to do that, what you do, you measure the width of the range, and then you project higher from the breakout level. And when we do that, we get targets up towards 4,800. But the thing with these targets are, well, firstly, they're just targets. They're not rock solid where the market's going. But the other thing is, it's never one-way traffic. The market just, or usually at any rate, doesn't just go there. It's going to be a series of pauses and consolidations along the way, and that's what I think we're currently in the process of seeing. As I've been saying the last couple of weeks, this is a market which has been stretched above these moving averages. So I've got the 50 and the 100-day moving averages, and the key message over that last 2 weeks has been that this is currently not an asymmetric entry point. So when I talk about asymmetric, I'm looking for opportunities where you can have maybe, say, 1 unit of risk for 3 units of upside. And I just think the risk parameters at the moment are potentially just a little bit too big for the possible upside up towards these previous highs. The time to get in was when we had the breakout back in May, early June. We're past there now, so now it's a case of, for me, it's a case of holding on to long positions and seeing how this consolidation plays out. We can put some Fibonacci's on. So I'm going to use, it's always like with Fibonacci's, it's like what low or what high do you use? I'm going to use the low from May, because I think that was the start of the last impulse wave. And I'll use the high from a couple of weeks ago. And when we do that, you can see the midpoint of this Fibonacci range is right back where the 50-day moving average currently is. So it would balance the chart nicely to see the market pause and consolidate, maybe come back into this Fib range, back towards the moving averages. And then from there, possibly we get another leg higher. Whether it works out that way or not, I don't know. But the Fibs give the Fibonacci region and the moving averages, does give us a little bit of idea of where the market could pull back to should this consolidation continue to unfold. And what's also interesting, I was looking at the so this is this chart I often use is the E-mini future. So it's a futures contract, and the futures contract trades for most of the day and night. It's almost a 24-hour contract. When you look at the S&P 500 on just a day session basis, it's an interesting pattern that emerges. You can see this little pattern here. This is called an island reversal. You get an island reversal when the market gaps higher. It trades at that elevated level for several days, and then you get a gap lower again. So you can see there's clear air between the previous day and the next, and then again we've got clear air here, and that creates what's called an island reversal. Now this isn't necessarily a dire formation. It's only got 3 days for the island portion. But it just could be another sign that this market just needs to have a rest. It's had a strong run, and there are a number of things I think lining up that suggest that there is a period of rest required. Also, just having a quick look at the just putting an RSI on, putting a 14-day RSI on the SP 500. Last week I was talking about the potential for divergence occurring, and this week we can say the divergence is actually occurring because the market did marginally make a new high last Friday. So now we have a situation where we have rising price action and we have an RSI which isn't keeping pace. So RSIs, I often don't pay a lot of attention to. A lot of the time I don't think they're overly helpful, but I do like to keep an eye on them when I do see these divergence patterns. They can be indicators that there is some sort of a change in trend, whether it be just a short-term change or something more significant. At this point, I think it's just a near-term pause, but let's continue to see how it unfolds. Another reason why I say this isn't an asymmetric entry point. It's a point, I think, to hold positions, but not necessarily to be charging in and trying to buy the dip at this relatively early stage. I want to have a look at the equal weight, S&P 500 equal weight. It's unlike the S&P 500, which has been in an upward trend for several months now. This remains stuck in a range. It's this big range going back to June last year. So over a year, the equal weight S&P 500 has been stuck in this big range. Now, there has been some encouraging signs over the last couple of months in that the price action is above the moving averages. So I've got the 50 and the 100-day moving averages. The 50-day average has crossed above the 100, so that's showing some upward momentum, although it is a range and it does chop and change quite a bit. But whilst the price is above the moving averages, you give it the benefit of the doubt. It is a positive setup. And we are in the upper half of the range. So again, that's positive. I think the point to make though is that it is range bound. So and it's still trading well below this high. So this is a high from February. Unlike the S&P 500, the equal weight hasn't been able to break this high from February. So I want to show you what that looks like when we put both charts. Both markets or both together on the same chart. So just have a look at this. So here, this top line is the equal weight, and the bottom one is the S&P 500 market capitalization index, which we usually look at. And so this goes back to 2006, and you can just cast an eye along here, and you can see there's a close correlation. They don't move in lockstep, but they move pretty closely together. What I want to draw your attention to is just the most recent price action, like using this high from February. So from February, we know that the S&P 500 has been rallying, but when we look at the equal weight, February high, it is we've got a market which is well beneath that February high. So it's divergence. It is divergence. There's no two ways about it. It's another flag. So we've got a flag on the RSI. We've got a flag with the island reversal. We've got a flag with the market being stretched above moving averages. And you bring all these flags together, and it just I think it lends weight to the being cautious. I know some people hate it when I say cautiously long, but hey, that's just how I see it sometimes. It's not a case of black or white. I'm a raging bull or I'm a screaming bear. Sometimes it's just you can have a bias towards one side of the market and play it cautiously, and that's been my play for many months now on the long side, and it remains the case. And look, maybe the equal weight does accelerate upwards from here, and this divergence disappears, and that often happens when you get divergence. It just disappears as the other market catches up. But look, it's just something we want to keep an eye on, and we want to be aware of. It's important to be aware of this stuff. Now, just briefly, Nasdaq, similar story to the S&P 500. So far, this is looking corrective. My preferred path for this would be for the market to continue to pull back, maybe back towards these averages, chop around for a bit, and then start to gain momentum again from there. Now, just because I say it's my preferred path doesn't mean it's going to happen by any stretch. The market doesn't care what I'd prefer to happen, but that would be a nice little sideways consolidation and a breakout. That's the sort of price action I'm I'm looking forward to see whether that evolves. Whether it does or not, who knows? We've just got to wait and see. But at the moment, I think this has potential to be a sideways consolidation, which then pushes higher. How long it travels sideways for and how deep it goes is yet to be seen. But I think the bias does remain to the upside. So at this stage, I don't want to buy this dip, but I maintain my core holdings. I think the trend remains to the upside. The overall trend remains to the upside until the price action tells us otherwise. Now, I'm going to have a look at the Russell in the moment, and I'm also going to have a look at a breakout in a really important market. But first of all, if you're getting some value, please hit that like button. Please leave a short comment. Just, hey, thanks for the video. Just tells YouTube that people are watching, people are engaging, then YouTube will show other people, and that helps me a lot. So please do that. And hit that subscribe button if you haven't already done so. Now, jumping over the Russell 2000, just a quick look at this. It is an important moment where we currently are. Market has come back to this support. We've got support at around 1,820. Not a major support, but it is a noteworthy support. Also coincides with the moving averages, the 50 and 100-day moving averages, which have crossed to the upside. And we had this break above the moving averages in June, and now we're coming back we had a test, a bounce, and now we're having a retest. I think it's quite important to see whether this market can hold the line around current levels without falling back to the lower end of the range. I still think there's a good possibility that this turns out to be a large basing pattern, but we just don't know. We've just got to watch how this price action continues to evolve. When things are in trading ranges, really trading ranges can go either side. They can break upwards, they can break down. You've got to wait for the breakout. As I say, I'd give my favour to this being a base, which will then, of course, imply a break to the top side. But until we get those breaks, you just don't know. And again, caution remains the play. Now, lastly, really important, US 10-year bond. Last week I was talking about how we're right nearing this downward resistance point. The moving averages were turning upwards. I talked about the possibility of a breakout. We've got the breakout. We have 10-year yield increasing. And now this is something which could be quite significant for these markets. It's within a whisker of an 8-month high, and this could put extra pressure on stocks and on commodities, at least over the near term. Maybe this plays into that consolidation story that I've been speaking about. When we compress this a bit, and you can see just here I've got a resistance band. Actually, let me just put this onto a weekly. This will give a better feel for it. So 5% is a key level. When you look at this going back to the early 1980s, you can see 5% has caused the market to react in the opposite direction several times, and it's going to be interesting to see if it does get to 5%. Will 5% cause a reaction? Well, in this case, it'd be to the downside, but to get to 5%, there's quite a bit of an potential increase in the interim. And it's also interesting because we can do a measured move. So let's just do a measured move of this last increase. So if we measure the low point from July up to the high in October, and this is in 2022, the October 22 high, down to the recent low point. And it gives a projection which does come up to around this 5% sort of mark. So it's taking the length of the rally and the decline, and then it's projecting the same upwards, and that gets us up to that 5% mark. So if yields go from currently around 4%, add a whole percentage point, that it's another risk factor for the market. So we've got to just watch this price action, see how it evolves. I think it's important, and it's and maybe it is going to add into this potential for further consolidation. So look, let's leave that there for this week. Thank you for joining me. Hopefully that's been interesting, giving you a few things to think about, and I look forward to coming back to talk to you next week. Till then, bye for now.